So there's a thing out there. I'm sure you've heard of it by now, right? It's obviously been plastered everywhere by agents and lenders. It's called the 2-1 Buydown. So if you're not familiar with what it is or how it works, let me explain it to you. So 2-1 Buydown is a temporary rate reduction. So, but it doesn't actually lower the rate of the loan. It effectively lowers the monthly payment of the lower rate. Now, let me explain that. So the money has to come either from the lender or the seller, to buy down, to do a temporary buy down of the rate. So let's just say, for example, you have a rate of 6.5. The seller puts up the money in concession to give you a 2-1 buy down. So that means your first year, your payment is based on a rate 2% lower. Then at the end of 1 year, the second year, the payment is based on a 1% lower. And so the way that works is the money that the seller put up, you make your payment based on 2% less. And then what happens is the lender reaches into that fund that the seller put up and they pull out the shortage and they add it to your payment to give them their full payment. So the loan rate is not actually lower. Now, here's the good news. Now, let's suppose you get a 2-1 buy down and rates drop, like say in 10 months. Well, you had another 14 months of money sitting in the fund to make up that shortage. Well, that money belongs to you. So we can effectively use that money to pay the closing cost on refinancing to the low rate that came down. Because remember, at the end of the 2-1 buy down, the rate is going to be the rate it was when you bought the loan. So, it's a good deal. So if you can get it, then jump on it. But if you have any more questions about it, just call me. 801-999-8209. Thanks. Make it an awesome day.